Good morning here in the US. It's afternoon in the UK and wherever you're listening to. That was kind of a weird start. I've never done it that way before, but whatever. So this is Exploring the Process, episode 12. We've got Chris and I here this week, and then believe we're going to bring back Ribbit for kind of a part 2 session next week. So we're going to dive a little bit deeper into his process, into some of the kind of, he uses a little bit of technical analysis, stuff like that. So kind of getting into a bit more the decision making rather than kind of a bit more the philosophical kind of overview that we had last week, which was a really good session. So if you haven't listened to that one, definitely dive into it. This week, Chris, I think you and I are going to kind of go back really almost to the basics, right? So I've had a number of requests via email and Twitter kind of DMs. And I think, you get them all the time, especially even on the arena, right, Chris, in terms of, how can I get up to speed faster? Or, how do you leverage XYZ tools from Hedgeye? Whether it's RTAs, the risk ranges. Again, Chris, last week, you're one of the things that folks commented on was, just start, right? Just start the notebook, right? It's going to be shit. It's going to evolve, it's going to get better, but just start writing things down. So I think this week it's going to kind of be for a bit more the, I guess, new subscribers or ones that have kind of, again, you can be, to me, I'm still learning. I'm 2 years in. I know, Chris, you're still learning, 4 years in, right? So 5 years in. So, you never really stop, to be perfectly frank with you. It's just the I guess the things that you're tweaking or adapting change, right? So I know, Chris, you're getting, much deeper into a bit more of the, I don't know if automation is the right word, but just sort of a bit more of kind of like the inner workings, right? Of like how the mechanics of sort of the process, and that kind of thing. So I know that's something that's basically been working on for the last few months. But for many, at the beginning, it's just more of like, okay, how do I execute better? For some of our European or international ones, Chris, I'd love to kind of pass it off to you. And just in terms of, I know you started with, I think, ETF Pro, right? Out of the gate. You started with a Select.
So I'm just trying to think. Yeah.
We've talked about it before. I want to say it was.
So it was definitely ETF Pro and something else, because I think I admitted it before then.
I think it was risk ranges. I think it was risk ranges and ETF Pro, maybe. Yeah.
And I thought I admitted I was one of these people that thought, oh yeah, I can sub for a bit and just figure out what it is, and then basically get the map, and then I can just take the map away with me and go and play. It didn't work out that way, but yeah.
It's hard. Now you have, just so everybody knows, now you have the Platinum Pass, right? Like they basically get everything. You have RTA. So we both have RTA, risk ranges,
ETF Pro,
macro show, investing ideas, early look. Do you have the call as well?
No. See, this is the bit that's hard for me, because like I don't really trade stocks, so it's
no, I know, yeah. So but just to give out people, just to give people, okay, cool,
So it came up. Let me. I haven't got the one here. So just like combine, like the question came up on the arena about this kind of thing, about obviously the recent short squeeze that there's been in the indexes and all that, and everything that goes around what's just happened there. And I kind of tried to explain it in a visual way, but it doesn't always work out that way. Why is it so difficult for me to find this big giant green button?
I don't know. You would think almost 3 months in you'd have figured it out by now, but
right. So can you see my screen?
Yes, sir. Yep.
Right. So I use these on TradingView. I use these, which is up here. So in this little tab here, you can have a long position or a short position. Okay. So this for XOK, this is a short position. So it doesn't matter. This is the top end of the range. This is the bottom end of the range. But for me, this just symbolizes, because it's a short, if it goes into the green, that's the short is working, right? So in the opposite, if it was a long position, it would look like that, right? So that's how I represent. So when I put stuff on here, if it's based on a risk range, that's how I use it to represent it.
Okay.
and then I'll have like
No, folks are going to wonder like how do you determine like where you set sort of like the top end of that? Is that off of your stuff that you've built or?
No, so if I'm showing it like this,
Yeah.
it's normally off the risk ranges
Okay.
on like, so from Hedgeye, right?
Right. Okay.
Part of the question that come up, so I'm going to put 2 on here. Okay, now they're offset just as an example.
Yep.
But just think of them. So if the price is, if it's on this day, you just have to think about the both levels, right?
Yep.
So let's say there's a crossover between ETF Pro and the risk ranges. And for this example, let's say it's XLK. So let's just, as an example, XLK is a short in ETF Pro and a short on risk ranges, right?
Yep.
Now, how I've explained it in the past of how to compare it, and it's not always the case, as has been explained before, it's not always the case that there's that direct crossover. But how I try and combine the two is, let's say that this is the risk range on ETF Pro.
Yep.
And today, this is the risk range.
Yep. I got you. Because because for those lists, like so just the point I'll let you finish obviously because I apologize for interrupting, but the difference ETF Pro, and for those that don't know, that's the trend range, right, versus the daily risk range, which is more the trade range, right? So it's more shorter term versus the longer term, so like 3 months versus like 15 to 15 days. So anyway, but sorry, continue, Chris.
So like I said, you have to there is a bit of, because it's not there's not always a direct crossover.
Correct.
Okay. So there is a bit of a kind of, you have to kind of figure this out. And that's where RTAs is much, much, much better now. So in this scenario, if it's at the top end of the risk range, then yes, it's short, but it's not as good as if it's like that.
Correct. If they're basically both being synced. Correct.
Right.
Correct.
So that's what I was trying to, I was trying to explain it on the risk ranges is yes, on the arena, sorry, is yes, it's at the top end of the risk range and therefore it's a short, or you can add to the position or you can build the position or whatever it is, but it doesn't mean the same things across all timeframes. And I think that's what we've come up against a lot in the last couple of weeks, is that people were looking down here at the very short term and thinking, oh, well, we have to short because it's at the top end of the risk range. It's like, yeah, but on the longer ranges, there's still a lot of room to go.
Yep.
So yes, it's a short, but it's only something that you might only have on, overnight into the next day, the price drops and you take it off.
Right.
You have to be much more tactical. Whereas now, in this scenario, obviously this is a perfect example.
Yeah.
But now, in this scenario, is where you can start to get,
and you can kind of let it ride a little bit and take advantage of like this the cycle, basically the full investing cycle. Yeah. Right. Exactly. Yeah. No, it's a really good, and I think that's certainly when I was first starting, right? Like if it was on ETF Pro, and like the trend, like that was typically, again, it's burnt me though, because the trend, you'll get like it'll go above, again, like they're constantly moving, so you always have to look at you with your espresso. I love it.
I worked for an Italian company for 5 years.
No tea for you today. But my point is that those trends are, sorry, the ETF Pro trend ranges are set on like from Friday night and basically are given to us on, basically Sunday, right? So it's like pre-market Monday. So those shift as volatility shifts, right? So if volatility is, depending on which way it's going, right, it's going to impact the range negatively or positively. So that's something to also consider, right? So I've talked about, on Twitter and whatnot, about like setting limit orders. And I think it's really important for folks that might not be able to like be as active, right? And, there's a gentleman out of Australia who I mentioned on the last call, and we've been kind of emailing back and forth, and he's been very curious about sort of just expanding and bettering and understanding kind of how international folks kind of leverage the tool. And he's waking up in the middle of the night to kind of check like what is hit, that kind of thing. I think that's obviously one way of doing it, but if I'm him personally, and again, you're European, so please, I want to know your input here from more of an international standpoint. But to me, like if it's something where you're either working all day and I think it applies to US too, like if you're working all day or what have you, do the work in the pre-morning, right? Or the night before. And when you get those ranges in the AM, you're going to have like the ETF Pro. You can basically set up like Monday night, right? Or even Monday morning, whatever it is. They come once a week, right? So, you might have to adjust those down depending on what down or up, depending on what volatility is doing. But I think that's a really good or key like learning thing, because if it's at the low end of the range on ETF Pro, then and in the bullish, like continuing in a bullish trend. So you're not really worrying about, again, you're having to pay attention to the macro show and like what Keith is saying, right? So if it's like the signal is starting to waver, I mean, that's the downside, right? Is like if the signal is wavering, then you don't want to have that limit order on, because you would need it to sort of play out a little bit more. But if it's, bullish trend, like XLE is a great example, right? Like it's been gangbusters right now. So, trade and the actual trend line are well below where it is today. So when we get the ETF Pro update, this weekend, that bottom end of the risk range is still likely going to be well, quite above certainly trade, I would suspect, right? So, if you're getting it below that price, let's just say volatility blows out next week. Again, just hypotheticals here, that low end of the risk range is going to go lower. So having a limit order, 1%, 2%, again, you have to kind of beta adjust it depending on the volatility of that underlying security as well. So again, I'm trying to make it simple, but it's never just that simple. It's never just one thing, as Coach likes to say, right?
This comes back to our chat last week with Rivet, right? We have to understand what like this is, without being a dick, but this is the big leagues, right? It's never easy.
It's hard, right? It's hard. Yeah. No,
exactly. And I get it. I get it. Everyone just wants things to be simple and just do this, just do that. But it's not like that's everyone will know, right? Everyone will know from something in their job. There'll be something in their job that will come along and someone's like, oh, just quickly describe what you do at work in like 2 minutes. And it's or someone new is starting. Can you just explain it? Oh, it'll only take you half an hour. And it's like, what? Just so how people can think that everyone always thinks that their own job is really hard, but how people can, like, without being a prick again, how people can think that they're coming into this and it's just all going to be easy and just do this, and just do that, and you're going to beat all these hedge funds. It's not that easy.
Right. No, I agree. And the tricky thing too, and again, this is why we love these sit downs, because we get to talk to folks that have all sorts of different ways of investing. Some folks are more active, some folks are a bit more passive, like our first one with Joe Cat, right? I mean, full-time job, he literally sets up the limit orders. He can, sometimes he'll check them during the day, but that's a good example. And then we have folks that are a bit like Rivet, that now also has a job, but he's a bit more active because his job allows him to do that. So same with myself. I have a full-time job, but I can, I'm here on my desk and I can kind of toggle between both like work and the screens, right, from the game. So but yeah, go ahead.
Just thinking about that, like with limit orders and stuff, especially for people trading outside of the US, if they trade in US stocks, is just being humble that you're going to miss stuff. You don't have to catch everything. And at the same time, there'll be things that rip that you miss, but there'll be things that absolutely like just get taken to the woodshed, and you also miss that.
Yeah.
Right.
Yeah.
So it's just, I think we talked quickly about, understanding what is the average daily move last week, right? And it's like that. It's like there are things that you will miss, and there are things that you'll miss. So it's like, it's on both sides. You have to kind of, you just kind of have to just, I guess it's the anti-FOMO. You just need, there's you're going to miss. There's things you'll catch and there's things you won't. It's
completely. And Coach, again, it was a bit of a shocker last night. He came into the notebook review session, and we talked a lot about position sizing, right, and getting to that min, and then when you get the opportunity, taking it to the max. And you and I have talked about this, and even on our first episode with Joe, it was about like capturing the move, right, and it's something that I've certainly been working on for really since we had that conversation with Joe, because just a light bulb went off like 3 months ago. So that was awesome, and I think that's the other thing too, right? If you're international, right, and making sure you're big in the moves that where the setup is primo, in my humble opinion, right? And whether what that looks like, maybe you don't know what that looks like now, but work on getting there so that when you see, again, like gold is kind of a good example right now, right, where it's in the consolidation phase and it's giving you a chance to build up your position and taking it to 10-12% max position, whatever it is for you.
Yeah.
But it is definitely tricky because it could roll, if it's possible it rolls over, right? It's possible that like that low end, again, that low end risk range starts to creep down. And so that's the other thing, I think, when you start tying it all together, when you're looking at the risk ranges on a daily basis with the low end of gold, right? So I think that's the key thing. So if you've got limit order set, or if you're trying to build up a position in an asset class that you want to have on for what should be kind of a more full cycle kind of investing process, which again, that's where you get the biggest gains. You just got to be cognizant and like kind of keeping track of like where are things moving and how do I need to adjust, right? Like, do I need to bring that 177 limit order on GLD down to 176 or 175, or do I just need to kind of back off it altogether and kind of and again, kind of let things kind of play out? Do I put in some trailing stops? Like, there's all sorts of different ways of kind of again, especially if you're sleeping, right, in Australia, like they got the bracket orders, the trailing stops. Again, I know Coach isn't a huge fan of trailing stops, but he also basically stops himself out at a 12% position. He said that many times, because once you get beyond 12% in a certain position, it becomes more and more, it becomes like harder and harder, basically, to make it back, right? Once you 12 is basically, I think, like 13ish%. So it's not a huge like change. Once you start getting to 13, 14, 15, that's when you start having to basically do, turns into, I mean, you guys can all do the math, but yeah, so that's again, so whether you use 12% or you use 8, again, it all depends on the asset class, the volatility, et cetera, et cetera. But that's just one way, again, to kind of potentially try to combine a few of the things.
I think we've talked about it on these. I was actually surprised that there was a lot of feedback from quite long time subscribers about the position sizing. I was surprised by that. I listened to the replay last night. This morning I couldn't join last night, and we've definitely talked about it on here about a portion of the size, like a starter position, half of it or a third of it of a full position, like that's kind of your trend following part. Yep. If it's a 6% position, maybe you have 2% or whatever your min is. That's kind of the trend following part of the trade, right? Yep. So it was interesting, and that's it's great that he came. It's great that he came on and explained that, because it helped a lot of people. But I was actually quite surprised that obviously they're not listening to us.
No, but that's a good segue though, right? Because Hedgeye, if you're a subscriber, has Hedgeye University, and there's a lot of content on there, and it's a phenomenal place. It's certainly where I got started, right? I mean, it goes through kind of current market setup, right? Like the GIT model, the growth inflation policy model, which drives like the nowcast and drives the quads, and then gets into kind of position sizing, right? And so again, I mean, he's got a whole kind of like video on position sizing, and that was one, certainly when I was starting, that was, it was, I can't tell you number of time. I mean, I have the notebooks, like I wrote down positions all the time. I mean, I just know, I know exactly what they are for FX, fixed income, equity. So like when he was spewing those off last night, again, I'm not trying to like pat myself on the back. It's just, I wrote it down so many times that I know them. Now
I think as well, another one that people were surprised by were that the sizes changed.
Sure.
Yeah. that was interesting. There are so many conversations. Like, I think we've talked about this before, especially when I don't know, maybe like 2 months ago, there was a whole kind of thing, like people were kind of falling out of love with the macro show. And I tried to explain it, like people don't know what what is now a given, right? And I thought there's so many conversations that I've had with people thinking that they were a long time subscriber, and I'm now like, it's because he didn't get that.
Yeah.
So I thought it was a given. I was like, okay, well, this guy's been subscribed for longer than I have, so he must get it. So when I was talking about it, and it kind of had a glazed eyes look, I was like, now I'm looking back, I'm like, oh, okay, I get it. Because he didn't understand that, like, the positions get smaller in quad 4. Your equities, in quad 2, it's like 6%, and in quad 4, it's down to like 3. So
yeah,
that makes sense now. But
and again, I mean, it's like one of these things where I was first starting, I was absorbing a lot of this information, and maybe not everybody, dives in as 2 feet head first, whatever the saying, however you want to think about it. But I just absorbed it all. It was just, it's still very, I'm still, as you can tell, I'm very passionate about it. And I love the agile process. I love kind of just the coaching from Keith, et cetera, et cetera. I think there's nothing else out there that provides the individual investor that level of high quality, like, map, guidance, I don't know, you name the synonym and it's there, right? So, but that is, Chris, what you're talking about is, I don't know if it's on, I'm sure it's on Hedge Universe somewhere, because that's where I found it. But it was like they lay out like the positions for quad 1, quad 2, quad 3, quad 4, and they're all 6% except for quad 4, I believe, on their thing back in the day. They may have taken it down because I haven't seen it in a while, but it's 4.5%. But yeah, I mean, you bring them down, right? So it's, and the same thing for, I know there's something on there for beta adjusting. So the same thing with like a high volatility or a high beta stock, right? So last night he was talking about, and on the pitch yesterday, T-Mobile, right? It's a 0.5 beta is what I think coach was saying. So you can basically, so if your biggest position is, say, for single equity is 2 or 3%, let's just say it's 2, maybe on a much lower beta equity, you can gross that up to 2.5 or 3%, whatever, again, whatever that sizing is for you. But you but then something like good example, something like an Oost, right? Or an Ooster, right? A small cap, high vol, high beta, equity, you're going to probably keep that to 75 basis points or maybe 1%, right? So you're going to, so you got to kind of also kind of adjust it, not only for the individual securities, but even for your ETFs, right? Like XLU, much lower beta versus XLK or QQQ. Same with XLC, right? So if you're short XLC, much lower beta, you can go big. Like I'm bigger in XLC than I am in like QQQ or XLK because it's a lower volatility ETF, right? So lower beta. So I can go, my max on a short is 3%, but I'm comfortable taking that to kind of like basically 3.5 because of its underlying measures. Yeah. But all right. So getting back to kind of starting off, Hedge University is obviously a huge place to go.
Yep.
Did you leverage any other? I mean, now they have their arena, right? Which again can, if you find the right people in there, it can be quite valuable. Sure. I think there's, again, there's a lot of Jedis that want to help, right? And I mentioned this on Friday in a tweet, just like, listen, if you need help, ask for it. And that's kind of what spearheaded a number of my inbox that kind of blown up over the weekend, which is great. I mean, I love it. And again, it's part of, again, I'm passionate about it. You're passionate about it. And many folks are passionate about it. Hence why, we have kind of these notebook reviews and we have Other Side Asset Management, X2, Trend Wizzo, Jimmy, Gavin. I mean, the list goes on and on in terms of like folks that continually kind of participate and that kind of thing. But was there anywhere else, out of curiosity, that kind of helped you either get up to speed, or was it just kind of diving deeper into the weeds?
Big thing for me was probably like I went back and watched a lot of old macro shows. I went back, especially around big points where I thought like I'd really either fucked things up or had that moment of like, this just doesn't make any sense. So I'd go back and look at what some of the macro shows. Now, some of them weren't that great at the start, but
Yeah.
but yeah, I found that really helpful. Um,
And there is,
this
and for those that aren't aware, there is a search functionality in there, so you can put in keywords or dates. You can custom range it. So again, I've found
yeah. So once you go in, because I've had to go back. If anyone at Hedge Eye's watching this, you can share your eyeball data. I'd love it, but I've had to go back day by day through the macro show chart deck to get the eyeball data, which was painful for
that sounds
going back
that
3 years of the macro show.
good Lord.
But once you put in the search, the first answer that comes back is normally pretty crap, but then it gives you an advanced bar at the side when you get that first bad answer.
Yeah.
It gives you an advanced bar, and it's much easier to do it then.
And then you can also actually put in date ranges too in there. So if you
Yeah.
wanted, like, for instance, like a month or so ago, I was kind of diving deeper into like the 2018 kind of fall and going into 2019. So that was, you can kind of narrow it down, macro show, that kind of thing. Yeah, totally. So that's another good tool.
So there was that one. So I'd done that. So kind of big dates more recently, I'd kind of go back and just have a look. And then early look, doing the same for the early look helped a lot.
For me, the early looks actually help almost more, just personally, in terms of, because I find like the content is all, again, he's trying to condense like a message into a short note, right? So he's, so over the macro, again, like he does a phenomenal job of condensing it on the macro show as well, but certainly the early look, you're going to get in his mind what is the most important takeaway for that day, in that moment of time. So anyway, but that was, I love kind of going back and reading some of those early looks for sure.
Unfortunately, it like with anything, it takes time.
Yeah,
that's the thing. It was interesting. So that email about the comment about the notebook last week, that was nice to hear, but you just have to start it, and you start it. It's going to be crap when you start, so you just need to get it done, and just the only way you can make it better is by starting a rubbish one right now. So
right.
You learn Keith talked a lot about the RTAs and how he's changed his kind of how he's using them now, but you get a feeling of what he's not talking about. Some of my biggest mistakes are thinking, oh, that's at the bottom of the risk range. A bit like the explanation earlier, right? Yeah. Oh, that's at the bottom of the risk range, or that's at the top of the risk range. So I'm going to whatever, short it or long it, whatever. And then it goes against me. And then when I go back and have a flick through my notebook, I'm like, well, Keith hasn't talked about it for a week.
right.
He talks about, like, and that's the thing. He says it all the time. I talk about the stuff that I'm doing. I tell you what I'm doing.
Yeah.
So if something might be at the bottom of the range, he might not notice it, or he has, but he's decided not to take it, and you take it and it works. That happens.
Yep.
But also at the same time, like anything, everything has a probability. So
yeah. You take it. Yeah, go ahead.
If he's not talking about it, that's also a signal.
Completely. And again, sometimes it's not even trying to be a hero, right? It's just trying to look and be like, okay, this is the bottom of the range. It looks good to me. Let's execute. But it's such a good point. And again, it's gone both ways, right? Where in hindsight it's worked and you're like, awesome. And then 2 days later, right, Keith talks about it on the macro show, you're like, boom, I saw that, great work, good job, Robbie. But then there's other points where it's like it goes the other way, and then he talks about it 2 days later and he's like, yep, this went bearish trend, good thing I didn't hit the button on it, like blah blah blah, right? Or that kind of thing. So you're spot on, right? And those are the things where you're only going to improve by one, doing, and two, taking the notes and kind of just improving, right? And kind of learning from your mistakes and understanding, okay, what transpired there. And I think this XLK example, which again has been up, it's such a good visual in terms of the immediate term trade range versus like the trend, and that kind of, and it's just, when you get those kind of setups, that's when you want to have, again, I've preached patience, and I didn't have patience. I mean, I had it for like 6 days, and then I just, it was at the top of the range, and it was like the 22nd of March, and I had to hit the button on triple Qs, right? So it was like, I hadn't done it. I didn't follow it on the 17th, but long story short, it's all good. Like I own that. I own that reasoning. I still feel, I know why I did it, right? And I'm okay with that execution. But then there's setups like we had Tuesday, and it was just perfect. It was like perfect. It was, it was volatility. It was going to the low end of the range. Basically every indices, every asset was basically, pushing the top end of the risk ranges. And it was just an absolute perfect setup. And so that's when you have to have confidence in what you've done, in the work that you've put in, and just be able to take the shot, basically, right? And kind of go across your book and execute. And I think those, again, they don't come often, or they come a couple times. Gavin has recently kind of talked about, certainly in this market, about like there's kind of like 2 times a month right now that like he's really executing. Yeah. And Tuesday was one of them. So if you go back and look, right, go back, in my humble opinion, if you're kind of new, go back and look at like what transpired all of last week leading into really from the 17th, I guess, probably, right? So like from basically where's the 17th, the 15th is like that last green red bar, right? That's the 15th.
Yeah,
that's yeah, okay. So good. But I would go from, that was 2 weeks, 2 weeks Monday. So go back the last 2 weeks, think about everything that's done, all the early looks, rewatch try to rewatch the macro shows if you can, and assess, because again, I think we're going to be very, very right here in terms of like that setup on Tuesday. But if you could have held off and like basically deployed everything and just been confident, one, of flipping at like on the 14th, which Keith did cover like basically everything on the 14th. So like he did a phenomenal job there. Now the mistake I made is that I didn't go long. I didn't really flip and add a bunch of long exposure in my US book. I have EM, I have whatever. I have like some longs, but I did like an energy trade. Anyway, we don't need to get into my fucking positions, but that was a mistake I made. So I'm going to be more conscientious, right? When I see these setups developing, the next time to flip, right? I mean, we go both ways, and that's how, again, like I missed out on alpha here in the last 2 weeks. But
do you want to know something?
What's that? Did you get long?
No.
Oh.
I explained before.
Yeah.
I explained last week what I saw. That's why I wasn't shorting.
Correct.
But it's interesting hearing you say the next time I'll be ready. It means there probably won't be a next time, right?
But so that, here's the thing though, Chris. So when the price goes down and everyone's like, oh, we need to get ready for this crazy 10% bear market bounce, it'll probably go down 10% more. Yeah, exactly. I mean, it's so true. It's like
but that's the thing. Everyone will be ready for it.
Yeah.
Everyone will be ready for it. Oh no, but there's going to be this crazy bear market bounce again. Yeah. Okay.
So then, all right. So I mean, you've been doing this for longer than I have, right? So then, how do you? Because it's always changing. Because you and I both, I mean, we both know that, right? It's always changing, and I don't know where am I headed with this. My question is, when do you, like, what kind of setup? Because again, I know you have your checklist, right? So like, what drives the action, right? In terms of, I know you have the checklist, like the setup might be there, might not be, what have you. So I mean, like, what, like, do you typically let, because I know you weren't shorting, right? So like, do you typically just let things breathe a little bit longer than you would have in the past? Like, how has that evolved, I guess, from like when you first started and, you know, executing?
Um,
Does that question
so
make sense? I know that was,
no, it does.
kind
No,
of,
it does.
yeah.
Right. So,
Okay.
a big thing for me, um, right, going right back to the beginning. The big thing for me was getting caught because I came into this with, like everyone does, of nobody can time the market, right? And I think we've talked about this before. Let's say these are the 4 longs on equity sectors, right? So whichever one it is, you've got these 4, but Keith tells you to buy these 2.
Mm-hmm.
And he tells you when they're down and they look like shit. So you don't buy them because nobody can time the market. Now, those 2 may, in this perfect example, go gangbusters, right?
Yep.
And it follows the quad perfectly. So you think, oh, well, there's these other 2. There's these other 2 longs as well. So why isn't he buying those? I'm going to buy those because they're going to go as well, surely, because that's what the quad model says, right? And then I come back to myself, my previous trend following self, and it's like, no, you buy breakouts, right? So it's like, so it's the things that are expensive get more expensive. There's that part. I don't fall into that trap anymore. I've gone deeper than most into what the quad actually does and how it's not necessarily how it's forecast, but how it's calculated.
Sure.
I don't do that anymore. What else? I'm happy waiting.
Yeah.
I can wait now. The perfect example was gold. Gold absolutely broke out. Whatever it was that caused it, whether it was the war, whether it was quad 4, whether it was whatever it was, gold went on a tear. Okay. Now, I played that one quite well and I got big when I needed to. So I had that. But at the same time, I was happy taking profits on the way up. And on the first day, and I said it in, I can't remember where I said, like, it will have a day where it will pull back and everyone will try to jump in. And it did, and everyone did, and then it fell down again. Mm-hmm. Right. So I'm happy. And Keith says that, like, wait, when you don't think it's ever going to get to the low end of the range, that's exactly where it goes. Now, that low end of the range, that price might move. So the point where you think you want to buy, maybe it's at 70. And maybe when it gets there, the low end of the range is now at 75, whatever, random numbers. It might be higher, but the probability of it not going down anymore
is also higher. Yeah.
So yes, you're not getting it at 70 if you're in a value investor. Is like, oh, but I could have bought it earlier. Yeah. Yep. But it had a higher probability of going down further then.
Correct.
So what's like, there's no value in that. You know, pulling all of them out now, like cheap can get cheaper. Like that's it wasn't the same trade then. It wasn't the same trade at 70 as it is now at 75.
Correct.
So I'm happy. So I'm happy that the biggest part of me is I'm happy waiting. Now I've built some of my own stuff that I use so I can see it myself instead of relying on, you know, the risk ranges or anything like that.
Yep. Yeah, and I think that last point's a really tough mental switch. Both the thing of like, okay, I'm thinking you're thinking outside the box with the, okay, these other 2 like haven't gone, like basically appear like they're undervalued.
They're cheap because
they haven't followed. Correct. And you're like, and you're like, okay, I'm gonna buy, it's at the low, again, you're like, okay, it looks like it's at the low end of what would be a risk range, it can't possibly, can't possibly get cheaper or lower. And then you just start, and then basically, again, I've done it before, and you end up just start basically continuing to average down. And it's like, it's literally like the most old wall of old, especially at the beginning. It was like, okay, I'm trying to be smart, right? Because I missed something. And
so I'm going to buy this one because
I'm going to buy, correct. And then it just keeps going down and down and down.
Yeah.
And then, maybe 3 months later, like the kind of the market cycle kind of comes back and you do make some money, but it was a fucking painful 3 months of just sort of like having this fucking shit player on your team who finally had a good breakout game and, paid you back, but now you're trading them to the B League, right? And you're
It goes back to this. It goes back to the probability part.
Correct. And then the weighting,
so
right?
Like, so it got called out. It got called out on the macro show about the probability of all the different quads and how they changed, right?
Yep.
So you've got the probability of the quad. Then you've got the probability of whether XL, whatever, XLA, make one up, XLA is going to be positive in that quad or not. So you have the probability, let's say it's 60%. Let's say it's 75% of it being quad 2, and the chance of it being positive in quad 2 is 60%. And then you have to layer on the fact of, well, is it even in an uptrend? Has it got positive momentum or not?
Right.
It's all probability.
Right.
All of it. It doesn't matter. Like it doesn't, and that's the big part of the quad. Like a lot of, so I was doing well with gold. Okay. It was my biggest position. I was doing well when people started to say, well, the stuff's going against us. But in a way, like in my head, I'm thinking that's because you're doing the next bit too early, which is shorting, because you didn't get big enough in the longs.
Correct.
So you're trying to catch up by, maybe you missed the first leg down. So you're trying to catch up like, oh, that was great. That was a great, like 6 weeks, 6 or 7 weeks when everything was going down. Like I didn't believe it then, but now I believe it now. And that kind of feels like what you've said about, oh, I'm going to be prepared for the next bounce. That kind of ties into this. It was like, oh, everyone saw those like 6, 7, 8 weeks of everything just trending down and down and down. And oh, that went really well. So now I want to get back to short again.
Yeah. And what I mean by that more so is taking a better evaluation of my longs and shorts, really, right? So like from more of a position sizing standpoint. And again, it's like utilities would be a good example, right? It's like, he added them not only to the risk range like a month or so ago, but then he added it to ETF Pro. I believe it's on ETF Pro. Yeah, it's on ETF Pro. So I just want to make sure I'm not misspeaking, right? It's on, and it's like I had basically starter position, basically, right? But I never, to your point, I never really grew, again, because like at the time where volatility was in like the fuck bucket, it was like, okay, I had a smaller position. I was happy with that, and it was working a lot. And then it kind of went sideways, and I didn't really I didn't do a good job of like refocusing my energy and being like, okay, well, what if we go to the bottom of the range, right? Like, what if we move from like 36 to 28? And again, so I kind of saw it happening, but I didn't execute on it. So I think that was the biggest thing. Is like that's why I'm kind of like more peeved at myself, because we're gonna take a quick pause there. Chris had an interruption, and so we're back. So XLU is what we were talking about in terms of just, again, it's just, so again, I just made a mistake, right? And it's like, to me, sometimes, again, we said we were going to go back to kind of some of the basics, but we're kind of getting more into like, it's almost like a couch session for me right now. But long story short is what I was, so when I say like I'm going to be more prepared, it's more of just doing a better job of assessing, right? Like, how is my portfolio constructed? And at the time, again, I'm just going to go into what I did. I covered my shorts. I had basically one short on. So I was not short on the way up, like after on like basically the 15th, 16th. I did wait, when coach started to hit the button on the 17th, I did get going again. But then in hindsight, that turned out to be early, right? So then I did wait for basically further. Anyway, long story short though, is I did the right thing, which was covering, right? So I had like Google on and very, very small, like in terms of other core shorts, like basically took it all the way down to like to min. But I didn't do, and something that I have done in the, I didn't then gross up my longs, though, is what I'm trying to get at, right? So I didn't take an opportunity to, even just after we got confirmation of like kind of buying stuff that had positive momentum, because you've talked about, we talked about this earlier, just in terms of like, even if it's just for a trade, I think sometimes that's mentally, I have a hard time because I have historically been a bit more of a longer term investor.
Yeah.
And so doing a bit more of the momentum trade, because to me, I'm looking at it, I'm like, how can it possibly go up more? How can it possibly go up more? But you're better off, again, maybe in that situation, I don't go from a say 2% in Utes to 6. I'll go to maybe I had 100 bips, right? Or 150 bips, and just kind of see how it is and have a tight stop loss or whatever it is, right? Like there's lots of different ways of handling it. And that's what I mean by like learning next time or like executing better next time. It's not of like, I'm going to anticipate 10% return or like a 10% bounce. It's just more about like when stuff starts to kind of go against you, just pivoting a bit more faster and at least having, again, kind of a little bit more of something to kind of like either capture it on a very short term. And I did it well, like you highlighted for me energy like the last week or the week before. And I did that well, capturing a pop in energy and then also flipped it. So when I sold that energy, I actually went short, oil and short XLE. Again, bullish trade. But I just was basically, I did that well. I basically sold it and then completely went the opposite side because I was like, okay, I think we're at the top of the range, is going to fall again. And I was able to, again, so it's not about like me, but I think I learned from my lesson, I guess, really, right? So like even halfway through this rally or this, whatever we've had here, and we could go high, like, who knows, we could go higher. Now, again, I don't think that's going to happen, but you got to be prepared for it. But luckily, I'm not as thick-skulled, and I kind of learned halfway through, and I was like, okay, energy was at the bottom of the range. I wanted to own it. Like, let's fucking rock and roll. And then, again, I went to the top end of the range, and so I think that was a good assessment. But from like improving,
it looks pretty good today, considering it's been, what was it, like down 10% in what, three days or something?
Yeah, it's been off. So it's been crushed. But again, I think kind of going back for like early subscribers, I think, and you've done, like, you basically, you said you got better at the momentum, you got better at not kind of wasting time on like how the quads work or what the quads are set up. And it's like learning from, sometimes you got to go down that path and then, have a pint, at the pub in that town, and then you got to walk back and go down a different route, and, yeah. And you're just like, okay, well, that was fun, but we're not going to go down that again. Right. And so I think just learning, it's never easy. You're trying to play at a high level. And
a big part, like going back to the new subs part, a lot of the other stuff that you read proclaims some kind of certainty, right? Like the dollar is going to crash and burn because China is doing this, that, and the other. And there's this Shanghai gold contract, which means they're going to buy Saudi oil for gold and this and that, and blah, 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 blah. And America's going to sink into the ocean. Like, a lot of these people have to rely on this certainty because they have no certainty whatsoever, right?
Correct.
So all of these things, like everything that we've talked about following the hedge eye process, is that there's a probability. There's no certainty. There's no certainty that the S&P is going to go to 3,000 because quad 4. And he might have slipped last night on the notebook review by like saying like, I'm like, this is going to hell in a handbasket, but he'll never say, oh, I think that the S&P is going to whatever, because it's just a probability. I just think from here, the chance is that the S&P is going to go lower.
Yeah, because
and then you combine it with the next thing. At the low end of the range, there's a higher chance that it cascades lower.
Correct.
If it's a short, if it's going down, if it's in a downtrend, it's
Correct.
just a probability. Every trigger for an RTA, the ranges, the quads, it's a probability.
Correct. And if you haven't, I don't know if you watched the micro show yesterday, but he talks about, well, you did because you mentioned it, but the conditional probability, right? And he was like, greater than 70% equals some of the highest probability values that you're going to see. And that's why he has such a high degree of confidence in his nowcast for quad 4. Now, again, I mean, but again, it's a probability. It's a 72% or 75% chance probability that we're going to be seeing, the growth decreasing, which you've pointed out many, many times means that there's an 28% chance that is going to be something that's going to be something else, right? And right now it's spread between basically 3 different quads, but that could come, that could narrow down and something could happen, and basically whether it's quad 3 or quad 2, who knows, right? Again, it's probability, and it's leveraging the different tools and combining them to give you the highest probability of a winning outcome. That's something that I was pretty good at this, but then our conversations and many others, but certainly I got to tip my cap to you in terms of the patience to wait and to have it set up. That to me has changed my game in the last quarter and last 3 months, because you're waiting for basically the highest probability. Like in the past, or like basically in the first kind of year and a half, I would have been, would have gone kind of the lower end of the range. It would look pretty good. And I'll be like, okay, I whether I'm sized appropriately or not, I'd be like, okay, I want to get back up to my full position. I don't want to miss the next run up, especially like gold's a perfect example, right? In terms of, and now and waiting for that. But now on the flip side, it's like I have to be cognizant of waiting too long, right? And in terms of, because it happened last week, you were busting my balls about gold basically popped, and I was like, how does it look to you, Chris? And you're like, well, you're gonna fucking chase it now, right? And it's like, well, no, asshole, I just wanted to see how the setup was, right? Because I wanted to see if it was confirming trend, confirming everything. And you're like, yes, of course, yes, it is, Robert. But still, it's like, I think there's a fine line there, right? There's a fine line of waiting and waiting for the setup, but then you also have to be confident and comfortable acting and like executing, and that to me is like all about kind of preparation and combining all the different tools that you have at your disposal to make that decision.
I think as well, it's when I first started coming into it, I was like, at that point I'd kind of transitioned more, like for me, into futures. So I was way out over my skis on commodities. And when I speak to people, in a way, rightly so, because they've done so well. But obviously, you guys talk a lot about stocks, and it's like, there's other stuff, right?
Totally.
And that's the thing. And you brought it up a lot on the Notebook review about the go anywhere thing, right? It's like, you don't have to pick a stock to represent this trade.
Correct.
And I think Keith brought it up, I think a couple of macro shows ago, about kind of oil, the commodity, teetering, but XLE having having a really strong signal. So that's in it itself. XLE is an equity and has its own dynamics to do with the US and options and whatever else, where for a long time oil was through the roof and XLE wasn't really following it. It was going up, but not in conjunction with, oil was ripping like 5-6% a day.
Yep.
And XLE wasn't doing that.
Yep. No,
and now it's happening. Now it's happening the other side. So that's kind of, to me, that's the confirmation part of everyone chasing. But in a way, in a reply I think I made on the Arena, it's like when talking about the probabilities for the quads, there's a few people talking there about, like I'm looking now, if this down move doesn't confirm, to get more long. And it's like, okay, that's your decision. It's like, but now that we're here, wherever we are, 4,600, but what are you going to do now?
Yeah.
Are you going to buy it now?
Right.
It's just gone up. It's just gone up. It's just gone up 12%.
Yeah.
Why would you buy it now?
Exactly.
Even if you don't want to short it, because
why not just sit on your hands, right? Like let it come down to the low end of the range, right? Yeah. Like whether you believe it or not, just like let it play out, right? And that's exactly, I think that's such a good point, right? And but so going back to like the futures thing and stuff like that. So for some, again, sometimes we do focus, or I certainly focus a bit more on the US, but on some of like the international stuff. So where where have you found some of the products to be the most helpful for, like, say, futures or other, like the commodities or FX? Like what, because I know you said in the past, like risk ranges, you've only used kind of 25-30% of it, blah, blah, blah. What other, like what have you found kind of the most, not even worthwhile, but just sort of the
You get, so part of it, like ETF Pro, you have the macro positions in there, so they're kind of helpful.
yeah.
Investment ideas is, it's just kind of,
Well, it's like US focused equities basically. So
it is, but you can see, you can see how it's leaning in it. You can see like, oh, there's a lot of industrials, or
yeah, like sector
out of
stock.
the 15 positions, 6 of them are in like long
Yeah.
industrials or whatever. That's just an example. That's
Yeah.
not what
Yeah.
it's now.
Or like, yeah. I mean, there's
So
a
you
time in the
get,
fall, it was industrials and like REITs.
so you don't have it, so it's not exactly direct, but you have to kind of read the tea leaves
Sure.
to get the British out.
Yeah. No. Yeah. No. Yeah.
So for me personally, risk ranges, and then you have to pay attention and listen to the macro show. Early look is really good, but you have to kind of pull a little bit more out of macro show, especially listen to what he's saying.
Sure. Yeah. No. Yeah. That's it. Yeah. Awesome. Okay. And then, all right. So last thing, and we'll wrap up. And we've kind of talked about this loosely, but I think it's just the investing idea is kind of like triggered it. When you're looking at kind of the different products that you have, are there certain components that you really kind of like focus on, or like that really pop out at you in terms of things that you kind of check every day, right? Whether it's on the PowerPoint presentation, like for me, I always go to like the eyeball table right at the end. Like I honestly, I literally have it up all day long in terms of like, no, again, like I go through the whole deck, but like, I mean, I have it up like in the tab, like all day long in my, like on my computer, right? So like I'll have it and I'll kind of refer back to it. Or just, again, I'll often take those notes and put them in my notebook, but so it's just one example for me. But is there anything on your side from kind of trading, like, again, not diving so hard into the U.S. equities that you
Risk
rely
ranges,
on?
that's why I get quite
yeah.
I get quite protective when people start saying, "Oh, well, none of us trade FX, so why don't they put extra ETFs in there?"
Yeah. Yeah, exactly.
Like, yeah. So the big macro positions that are in.
Do you put those in Excel?
Yeah.
Yeah. And then do you track that? So do you track the movement day over day, or like how does that look in your, like how do you leverage them, I guess? Like what do you try to see? Like what do you try to garner, I guess? Like do you look at lower lows, lower highs? Like do you have anything that, because a lot of folks use Excel, so I'm just kind of curious, like what
so
components out of
so I use it. I don't draw any fancy graphs using the risk ranges.
Okay.
I don't know whether I should, but Keith says all the time that they're moving constantly. So for me, it's like they're not. When he describes them, it's like they're not levels of resistance or anything. So in a way, why do you need to know what it was a month ago?
Yeah,
because the levels don't. I don't know. Maybe there's more to read into that, but I don't do that.
Okay.
So I use it like the big ones. So the dollar, the 10-year, the other FX, oil, gold.
Sure.
Are the big ones for me. Because then although that proxy word, that can kind of then spread out into the own stuff that I do in terms of other FX positions and commodities, if I have those.
Okay. No, that makes sense. And yeah, so on my side, in terms of like kind of the overlay, as I said, it's risk, and we kind of gone over this, but I write down the risk ranges every day in my notebook, right? Then I get the call, so I'll listen. I'll often get to listen to most of it or much of it in the morning, kind of like while making breakfast or helping the kids, whatever, and I'll kind of have an ear pod in. But I do prefer I prefer almost all the content. I I find I'm much better when I'm focused on it. So again, maybe take again as new subscribers, like it's one thing to like listen while you may be doing something else. But if you're not like if you're doing diligent note taking or giving it kind of a real focus, and not everybody can, right? Again, I carve out time to do that, whether it's at night. So again, like I might listen kind of passively in the morning, and my brain again, but I come from like institutional equity background, right? So I'm used to having a morning meet. Like that's what I did for 10 years. Is like I had a 7:15, 7:30 morning meeting every day listening to analysts. And so I would have my notes and then I'd go back to my desk and I call my clients and, I'd kind of refer back to what is kind of impactful or changes to their views, et cetera, et cetera. So I kind of have an ear because I've done it for a long time, right? So I can pick out when key moments from analysts when they're talking. Now, again, maybe that's just why I also write it down, but that's certainly a big one to me. I think the call is, you get some other content, like some other key notes from Keith too, which is pretty cool, especially in the morning. So he'll be able to kind of expand a little bit more, maybe have it a little bit more, focused on, again, it's like a bit more obviously focused on US equities, but that's certainly an interesting one, or one that's, especially now that's in the like at 7:45, it's a lot easier to sort of have it kind of ahead of the bell to open. So yes, risk ranges, early look, obviously, tying down. I take notes even from the early looks, look, risk ranges, macro show, taking the notes, but then the ETF Pro and stuff and the investing ideas, that's written down every morning. Monday, it has its own page, right, in my notebook, and I'll look, week over week, are you getting higher highs in the longs, right? Are you getting kind of lower lows or lower highs in the shorts, right? Because again, that's going to give you a general map as to like where you want to be focused, right? Stuff that's basically continuing to be either bullish trend or bearish, right? Like and continue to your point, like the probability and the ranges keep either going down or up. Like I'll highlight those, right? Or I don't highlight, I star them, and I'm like, okay, these are like, if I get the low end of the range in these assets this week, like I want to own those, I want to gross those up, or like get to my max, whatever. So again, I'm just trying to think about, and then the RTAs, right? Lately, that he's done a really awesome job pivoting to much more of like real-time coaching, which if you're not reading those live, like you got to. And again, I don't always follow the RTA. Like, I'll use his, like for instance, like UUP. If I had longs to fucking sell, I would have been selling them. But again, I'm at my mid sizes, so I don't want to go any lower. But my point is that I was seeing that too on the board. I was like, okay, I was double checking my portfolio, being like, okay, is there anything that's like I should take down to mid position because it's U.S. equity exposure that basically it's unlikely it's going to get any better than this, right? And so you're gonna, that to me is a great call out. Like that was a real signal from UUP. It was obviously buy dollar, but it was also like take down your gross, like your long exposure, and put that in cash, aka the UUP. So those I think are really impactful. And then on the RTA side as well, to your point about like investing ideas, I'll use it more as like a guidepost as to like where do I want to go to put on my exposure. Like if he hits the button on Weber, right, which is like the grilling company, it's hard to borrow for me. So I'll take that and be like, okay, he's looking at like small cap retail. So I'll look at like the factor exposure and where he's going, and I'll go make my own decisions and see if anything else. Now, again, he's hitting the button on Weber because it's the best setup and the highest probability. So it doesn't always work when I go off book, but I can't, you can't always follow him, or sometimes the position moves too quickly or whatever it is. So sometimes there's also having patience, because you might not catch it on day one, but you can catch it on day 2 or day 3. And it's either at kind of relatively the same price or slightly better price, what have you. So I think just patience there too, and using those as more directional beacons.
I think one thing as well is to remember, I think we actually talked about this last week. Like he tells us that he's front running, right? He uses 15 days to front run everyone else that has to benchmark to the month.
Yeah.
So there's going to be times where he's going to be early and catch it, and there's going to be times where he's going to be early and be early,
right,
in both directions, up and down.
Yeah.
So it's even just having the
knowledge, or like the like
having the not like under
yeah.
like, it's like people take it as a given when it all goes right,
Yeah.
but then they forget that that's what's happening when,
Yeah.
and like, oh, it's not working. Well, he explains why he does what he does.
Correct.
So there are going to be times where it's going to be wrong. Just to that
Yeah.
point, it's like, and not every RTA is going to be like that one trade that everyone just has to make every time.
Correct. And yeah, so I mean, but yeah, so anyway, I think that's a good overview. And if you've got any, again, we kind of bounced a little bit all over the place today, but it was awesome. But if anybody listening or what have you, if you've got other components, right, that you're curious to learn more about, or how we kind of combine them, or how other guests, might leverage them, please leave comments below. We're always, Chris and I are always trying to help make these as impactful, and both in the moment, but also longer term. So like when a new subscriber comes on board, next year or in the next quad 4, hopefully they can come back and look at these and be like, okay, like this is what they went through last time, right? As subscribers,
what they screwed up last time.
It's what they screwed up last time. Right, exactly. Like McGroarty didn't get long at the bottom, it's like so but no, anyway, but yeah, Chris, always a pleasure.
No, man, I really enjoy it, mate.
Yeah, we'll get rivet on I believe next week, if it works with the schedule, for part 2, which should be a lot of fun. Again, a lot of the feedback that we've gotten is kind of get a little bit deeper, get a little bit more into the weeds in terms of like how you execute. So we're kind of want to bring rivet on for that piece. He's been kind enough to come back to sit with us, so it should be fun. It'll be our first return guest, right, with rivet. Yeah. Awesome. Well, have a good weekend, everyone, and Chris, we'll chat soon.
Yeah, all right, buddy.